So I would like to move to the questions. Some of them have been already answered by our exceptional panelists. So the first question relates to the fact that we tend to think of the link between monetary policy and inequality in terms of savers and borrowers. I guess this goes to Marcus's work, and it's asked that this seems like a very unequal decision, and how it could be addressed, given that low interest rate environment is affecting borrowers and savers separately. And in relation to that, there's another question which I find very interesting, that although we tend to think in terms of savers and borrowers, there is a part of low-income households or younger generations who wouldn't be in a position to get a mortgage, or they lack collateral, or they don't have a stable job. So how do we see the role of monetary policy for these segments of population? Maybe I can start with Marcus and then move to Adam. Marcus?
Thanks a lot, Phyllis. So I think that's very nicely put. Of course, when you do monetary policy, you create capital gains, and you decide when do you create the capital gains. If you cut interest rates now, you create capital gains now for certain parts of the population. If you cut interest rates later or hike it later, you will change it later. And one problem, I think, which is with any inequality measure, and Tarman mentioned several of these inequality measures, is that they're snapshots. While monetary policy is something over time. And then the big challenge is to what extent you create essentially capital gains now, and what extent you can create income effect. So let me just give you an example, that let's suppose you have a certain job, you get a certain stream or certain asset which gets you a certain stream of cash flow, you cut the interest rate, and nothing happens if you don't sell the asset. It's just you get huge capital gains, but you're suddenly more wealthy. You can live in this nice house, you get a certain utility stream or whatever, but it doesn't make you more wealthy in a sense. So the question is, if you measure wealth inequality, it's very different from measuring income inequality, and these are challenges here. But on the other hand, if you have capital gains and liquidate them, they translate then into income directly, and can use it for some other purposes. And that's, I think, makes the whole thing challenging, having snapshot measures rather than some dynamic measures. I don't think we have some good dynamic measures. I would like to come back also to what Tarman said on this equal opportunity. For me, and I think I very much echo what Tarman is saying, is that equal opportunity means great job opportunities, jobs, jobs, and jobs. And we know from some recent work, that jobs come back slowly after the recession is over, and then it grows at a cycle. Like Bob Hall had some recent work showing that actually you have job growth always growing at the same rate, essentially, until the next crisis hits. So there's no natural rate anymore. You get the job growth going and going, and then there's a crisis, and then suddenly the unemployment shoots up until the whole crisis is over, and then you have job growth again. So essentially monetary policy, to a large extent, in order to create equal opportunity, is to avoid crisis. So in particular, the buildup of risk, which then materializes in crisis later on, and then destroys jobs. I think that's very, very important. One should not forget this main insight. You also mentioned, so Olivier also mentioned, there might be some smart ways to helicopter drop, and he was skeptical about this. So let me add another skeptical, even more technologically driven example. Like in China, in Hangzhou, it is the case that they give out smart coupons. So you essentially go to a helicopter drop of smart coupons, which expire. So you have to spend them. You can't save this away. And you can even specify these coupons, what you have to buy, or what group of goods you might choose it from. And this might be a way to have a very smart helicopter drop. I'm very skeptical that this should be the way we should go, because I like the freedom of individuals to choose, rather than the government determining you should buy red shoes or blue shoes or whatever. But in theory, going down the road in the future, governments will be way more powerful to fine-tune and target consumption spending within a certain time window and within a certain product class. And I think that's a new way of doing helicopter drops, or fiscal, could be fiscal or monetary, which I think is more distortive. Of course, it gives the government much more power. And I think that's what has to keep in mind. And with this new technology, coming back to Adam's point, is more and more important that the central banks stay then within the mandate and don't, say, okay, now we do a helicopter drop that you can buy only red shoes. Let's say that would be very much might be stimulating because of certain industries and difficulties, but it's very much beyond the mandate, I would say. So we need a more clear definition of the mandate, going back to Adam, which goes beyond the time consistency perspective, but much more, how much are these central bankers elected from the public, the sovereign, the public, and to what extent we have to keep it with the policymakers who really get the power then from the people to make these decisions, how to redistribute and whom to help out and whom we don't.
Thanks, Marcus. So moving to Adam, just to repeat the question again. So what we could do for lower income households or to stimulate low wages? For example, do you think that the recent revisions to the US monetary policy framework is somehow responding to the inequality issues by focusing more forcefully on unemployment objective? Adam?
Yeah, thank you, Felice. And again, thanks to my colleagues for their comments, and especially Marcus for echoing or advancing, frankly, what I was saying about the time and consistency perspective. I think you're right to focus us on this question of wage growth. And so I would no disrespect to Tharman and Olivier, these longer term issues of optimal institutional design, essentially, and how we work the fiscal policy and coordination are in the short term second order. I realize that that's not their main point, and Tharman very forcefully talked about the need to respond to the pandemic special attributes. But so I want to go to two pieces of your question, one of which builds directly on Marcus's last point. So the first point is that one of the dirty little secrets of central banking for the last 30 years has been that they've been de facto wage targeting, or at least they were until secular stagnation came in. Because you would say, okay, we're targeting an inflation rate, but anything that's a supply shock or a one-time shock, we look through, we don't raise rates. We only raise rates when there is a sustained pass-through, a second round effect. Well, how do you determine the second round effect? Well, generally, the second round effect means it's passed through in wages. You almost never see a second round effect that's meaningful that isn't passed through in wages. And so, though the central banks never admitted this, most of them were doing this. And in an environment where the capital share was going up in the economy year after year after year, particularly in the US, but in most advanced economies and in some emerging markets, this meant that you were essentially validating or at least enabling that transfer of income. Because if you ever saw a gain in wages, you would say, oh, that's inflationary, even though it might have been at the expense of redistributing the pie rather than being inflationary. It might have been a one-time shock. And I don't want to suggest that there was some conspiracy here. I'm just saying that I started worrying about this when I was at the Bank of England a decade ago, that this is de facto where people ended up. And so I think the central banks moving away, rebalancing towards issues of full employment and issues of distributional employment as things they should focus on and talk about, is a way of getting out of that trap, because you need to make some kind of qualitative assessment, case by case. Is this rise in wages because of a just as justifiable redistribution as it was capital taking a larger share all these years? Labor may be allowed to take a larger share. You need to face some way of doing that. But the simple reality is in rich countries, and this is something Olivia and I wrote about on Japan several years ago, is that unless you have a currency crisis, basically you can't get sustained inflation without wage growth. I mean, can't maybe slightly overstrong, but pretty much. The second point, picking up on Marcus, is when we start talking about all these clever fiscal things that we can and should do, and I don't mean to dismiss my colleagues' creativity, because it is important to think about these targeted new fiscal ways of behaving. There is this question that Marcus raised, and you implied, Felice, about what is the role of the central bank. And the reason I was talking about the mandate as not being that important isn't, as Olivier says, I mean, the mandate does matter. It ultimately is the voice of the elected officials. But in practice, mandates are always going to be unable to keep up with changing times and are going to be vague. I mean, Olivier read out the Bank of England mandate, so the issue is when you're doing fiscal monetary coordination, how much should the central banker be talking? How much should the central banker be advocating? And again, we had decades of central bankers giving lectures on fiscal probity, and that led to an environment where the ECB, at least initially in the Euro crisis a decade ago, was very reluctant to cooperate with fiscal authorities. And again, this is something that's there's not going to be a design fix. It's not going to be something one and done, but that there has to be something in the mandates that recognizes, or a reinterpretation of mandate that recognizes central banks can voluntarily decide, yes, I am going to coordinate with monetary policy. And the question is, how do you put rules on that so that it's not just, okay, Janet Yellen or Jay Powell has more of a bleeding heart about unemployment than Alan Greenspan or Paul Volcker did, and therefore we get coordination. Or, we have a crisis and so they coordinate, and then in a crisis they don't coordinate. So that's where I think the research has to go. But the main point of these two things is going back to something I think all my colleagues said, is while these distributional issues about differences between savers and borrowers matter, the vast bulk of the action in inequality and in human terms is about people who lose jobs and don't recover, people who lose income for a sustained period or wealth and don't recover. And that's why I keep bringing my comments back to employment stabilization, because that goes with the short-term focus of most monetary policy, that goes with the more limited mandate that you're not getting too specific, and frankly, it goes with the biggest need, in my view. And if you start getting too much into the rhetoric and the technicalities, you have to do it. But if you get too caught up in borrowers versus savers, equity holders versus debtors, you're getting into something that's not actually that material for the bulk of people in the society. And it gets you into micromanagement that I'm not sure the central bank should be in.
Thanks a lot, Adam. So in the going with in the direction that monetary policy could perhaps be most productively contribute inequality through its impact on employment and protecting, providing stability, macro stability in terms of employment. I would like to go back to Olivier. Can we provide additional space for monetary policy making to focus on full employment policies? For example, can we make it more potent, for example, through increasing inflation target as you proposed a while back? Do you think that's a good way to think about how monetary policy can more positively contribute to full employment? Olivier?
Yes, thank you. So, given that Farman told me I should not respect my mandate, that was a major mistake. So I'm going to actually take up some of the points that came up earlier, because I think that a few remarks to be made. On the borrowers-savers issues, I think that's actually a very important issue. I disagree with Adam. There's actually some irony, which is that if you have a pay-as-you-go system, it's not the end of the world if interest rate is low. It's much more of an issue if it's fully funded, or if basically people save for their old age, which is an interesting twist on the notion that we should try to fully fund the systems. It actually makes them much more exposed to distribution effects. So that's a kind of half a remark and half a joke. And I love the idea that I think Marcus mentioned on these expiring coupons. It could be fiscal, and there's no reason it should be monetary, right? I mean, this is still, but the idea that basically you get the intertemporal substitution because there's no alternative is actually a very nice one. And I had not thought of this. Maybe there's something to be done there. On the issue that Adam raised, Chris Erseg, one of your colleagues, and I have worked on wage inflation targets rather than price inflation targets. And we focused on the effect in terms of stability, in terms of the efficiency of policy using the usual criteria, but it has different implications in terms of distribution. So I think you should go back to it and do what we didn't do, which is to look at the distributional implications of having a wage inflation target or a price inflation target. I think that it actually makes a difference. On your question, to which I now come, your last question. Yeah, I mean, obviously, I'm totally in favor of a dual mandate. I've never thought that inflation was such a, the goal. To me, as you probably know from my work, I've always thought of inflation as a signal that output is roughly at the right level. I don't want 10% inflation, but I don't care very much about stable 2% or stable 4%, except that indeed 4% gives more leeway. So to the extent that you want to give as much room for monetary policy to help for the usual reasons, forget distribution, then clearly I think 4% is better than 2%. And if we'd had this in the past, we'd have a bit more margin. So I continue to think that 4% is a better number than 2%. It's actually twice as good, roughly. But I'm not going to push for it now, because at this stage we have a hard time getting to 2. So my attitude there is let's get to 2 and then we have a discussion again. Let me start there and give the floor to others.
Thanks a lot, Olivier. So Tharman, in 2017 in Rethinking Macro Conference, you presented some out-of-the-box thinking on education, or rather the form of education. So what do you think that some of the longer-run scars or opportunities by the current crisis that can alter the landscape or debate going forward on inequality, or how we should think about it more broadly? And also, of course, in the context of monetary policy, what can monetary policy do in trying to mitigate the longer-term impact of the crisis on inequality? And there is one question that I thought, if we have time, or if we can quickly touch upon, on the global implications of inequality. How much, of course, with the current crisis, inequality in advanced economies is increasing, but much more so in developing world, given the structure of the economies, or some other structural issues, and limited policy responses given the fiscal space issues in developing world. So how much we should worry about global inequality as a central banker in advanced economies? Thanks. Tharman?
Thanks. And by the way, Phyllis, I should apologize that I missed your earlier summary and questions, because there's some problem with my sound system, but I caught on when Marcus started speaking. Maybe just to broaden your question and go back to something which Adam was saying, I think we need a lot more research and debate on the longer-term consequences of monetary policy. The traditional paradigm is that monetary affects the nominal and not the real. It affects the short term and not the long term. But there's so much blurring now. And I think there are a few issues which have just come up. First, on what Olivier and Adam were discussing, on the whole issue of pension funds and life insurance funds, I would say the longer we persist with holding interest rates ultra low, the more we're going to be building up a real problem. First of all, insurance funds, as distinct from the defined benefit pension schemes, insurance funds are hit in a very straightforward way when interest rates come down. They're hit on both the asset and the liability side. On the defined contribution schemes, clearly Olivier is right. And I would say there, we have to do some hard thinking about the way in which we organize defined contribution, because we're all very familiar with the American 401k type schemes, to some extent the Chilean model and other models. And they were all models that were not just about defined contribution, but about market-based decisions by individuals on their own as distinct from some way of collective management of funds within a defined contribution scheme. And we conflated the two things when we moved away from defined benefit. We conflated the two things and thought that defined contribution means that each worker has to manage and make decisions on their own as to which 401k to choose. And it's worked out pretty badly. And particularly now in an environment of low interest rates, I think we need to think hard about how we have collective management with very simple choices, if at all, given to ordinary people, given the very strong evidence that you can't put the risk on them to manage their retirement funds. Second long-term issue is productivity. Again, we don't understand this very well, but I think there's a reasonable case to believe that if you keep interest rates at a totally non-discriminating level, you're not going to be able to get capital market efficiency to work very well. And we already see in Japan and Europe and some other places, we already see the emergence of a lack of reallocation of resources away from firms who are just limping along because the cost of funds is virtually zero. So it's a very serious issue. Third issue is the long-term implications of the search for yield and the financial stability implications, in other words. Now, this is a bit more conventional, and central bankers are discussing this. There's a range of macroprudential policies that are talked about. Still a very imprecise business, but we at least know how to think about it. But the search for yield internationally is still an issue which is not very well addressed. The implications of domestic monetary policy in the largest economies for the search for yield internationally, and in particular for the volatility of capital flows, is still an issue which we know descriptively that there's a problem, and we don't have a very good solution for it now. I believe there is a case for the IMF and some other bodies, including the BIS, but principally the IMF, to be able to mitigate this and to have rules of the game that can lead to somewhat greater stability, but that's another topic by itself. But coming back to the point Adam was making about wages and the way in which monetary policy's role with regard to jobs is still so central. I agree, not just short term, but even when it comes to the longer term institutional factors that have led to increased inequality. If we think monopsony in labor markets is a problem, and clearly it is in many labor markets, if we think weakened bargaining power is a problem, there is a case, and Alan Kruger, in fact, made this point in the 2018 Jackson Hole Symposium. There is a case to say that if you're able to keep employment as much as possible at a full employment level, you're better likely to be able to strengthen bargaining power of workers who are not, including in non-unionized sectors, and also weakening the monopsony power of employers. So I think that's something that requires more thinking and more work as well. Finally, I would say that one of the longer term issues coming out of COVID that we now have to factor in, which Ken Rogoff has pointed out as well, is that we're very likely to see just heightened unease in the population for a long time to come, with the result being higher savings rates. It happened after the Great Depression. It just changed lifelong behavior. And it may well happen again now, and it'll accentuate the whole savings absorption problem that we have. So just thinking about the longer term consequences of traditional macroeconomic policy is an under-researched area. And even if we don't have very clean and simple answers to it, we have to, at least in a stylized way, start factoring it into our policy making.
Thanks a lot, Arman. So we only have 4 or 5 minutes left. So I would like to connect again to our theme of this three-day event. In the first one, as I mentioned before, we discussed what can central banks do in terms of financial policy. Then we discussed financial infrastructure, touching upon the issues of digitalization, financial inclusion, which is particularly important in developing countries, but also in advanced economies, particularly in the US. And now we are discussing monetary policy. I would like to get your views very briefly, whether you think central bankers, even if they would like to touch upon, incorporate more inequality concerns, that among the functions of the central bank, which ones do you think are more appropriate to address these issues? Maybe I can start with Marcus and go through our panelists very quickly. Marcus?
Yeah, so I think the central banks, as Olivier pointed out, should have an emphasis on balanced growth, and that's, I think, very important. And they should be flexible what instruments they're using, but it should be very clear what they're doing in a very transparent way, and they should stay within the target. So it should not be seen as favoring one group over the other group. Of course, to the extent that you hurt the whole savers, high inflation wiped out in the 70s the whole middle class, essentially, in the UK, in the US. You don't want to get this in this sense. It's very important that you keep the main target of price stability in your focus, that you make sure that there are enough jobs. That helps probably the poor the best. And then you, as Tarman mentioned, also put the pension fund situation into the game. So you have to have a multi-pronged approach. And for each of them, there might be a different instrument, which is the best one. But it should not be seen as the main objective of the central bank to do redistributive monetary policy. This should be done by the elected leaders who have a backing from the population, from the sovereign, essentially.
Thanks, Marcus. Thank you. Adam, do you see any role for financial supervision policy or inclusion in alleviating inequality considerations?
Yes, I do, Felice, and basically I completely agree with what Marcus said, so I'm not going to add anything to that. I think the financial, just as many people make the mistake of thinking about the global or North Atlantic financial crisis a decade ago as being a failure of monetary policy when it was really a failure of supervision and regulation. I think similarly, the action that central banks can take on redistribution or on inequality is primarily in the financial regulation supervisory space. And I know we've had 2 prior sessions with distinguished panels in this series on that. But just to say, part of it is crisis prevention. All of our colleagues have spoken about how damaging crises are. Part of it is to make sure that small savers and small borrowers are not exploited. And part of it is to do things which particularly are true in the US, but there are analogous things in other countries where you're exposing things like redlining of mortgage markets, where you had racial discrimination in mortgage markets. Federal Reserve Bank of Boston did a huge amount of important work on this, for example. Federal Reserve Bank of Minneapolis now is doing work on various things to do with housing. Federal Reserve Bank of San Francisco has done research on divided labor markets. There is room for both research and financial supervision together to make a material difference. And we shouldn't, today's panel was focused on monetary policy, but you're right, Felice, we shouldn't let it just go to that.
Thanks a lot, Adam. Olivier, is there anything that you would like to add as we're finishing today's session?
2 things quickly. The first one is I agree with Marcus and Adam that regulation supervision is probably where there is the most to be done. In terms of monetary policy per se, what I would like to see is basically whenever a measure is taken or a new instrument is put in place, that there is some analysis of the distributional implications. Whether or not it leads to a different decision, I think that information would actually be tremendously useful, and we can probably do a decent job doing that.
Very good point. Thanks, Olivier. And Tarman, is there anything that you would like to add for today?
Well, I think whilst we do not have a framework or confidence in a strict coordination between monetary and fiscal policy, the broad strokes are clear enough The need for fiscal policy to think hard about social and economic returns for every form of fiscal spending is clear enough. Low interest rates may not be here forever, but we've got to think hard about returns. We think so hard about central banking and think so hard about monetary policy, but there's just so little serious thinking in fiscal policy about fairly basic precepts. What are the economic and social returns to each form of spending? Second, the point I mentioned earlier, broad point, given that monetary policy has to be where it is for a while to come, you need to have a sufficiently progressive system of taxes and transfers overall, and it has to be designed in a way that's still supportive of and catalytic of growth. That's a principal objective. It's jobs and growth. And it can be done. And that's, again, a broad point. It doesn't require very clear coordination between monetary and fiscal policy or treasuries and central banks. But that broad point is, I think, fairly obvious. And third, I would just repeat a point I made very briefly earlier, which is that there's some things that you can get for free, which is coordination. Coordination is a real asset. If you can do coordination well, particularly in job markets, and particularly in the environment going forward, where we are going to get more reallocation of jobs in the economy, because a significant chunk of old jobs aren't going to come back, and people are going to have to switch jobs, not just within the industries they're familiar with, but across industry. It requires coordination. Coordination on skills upgrading, coordination on SME upgrading, coordination to make sure that when people move, they don't lose all the human capital they had in their previous jobs, but you find a way in which they are augmenting what they have. It doesn't happen without coordination. And systems which have coordination between government, be it federal or typically local, employer federations or industry groups, unions or other social partners, and very importantly, the colleges, or training providers. Those systems that do it well are going to get something for free. It doesn't cost something on the government budget. I mean, there'll be some incentives, of course, but it's not about the size of your fiscal deficits per se. It's about coordination in a market economy. And I think that's going to be even more important going forward. Thanks
a lot, Arman, and thanks other panelists too. Indeed, one of the questions, we have gotten several questions on this issue. But mostly on the fiscal side, there were a couple of points made in the chat box that perhaps in more broadly, if fiscal policy is more active in addressing rich-poor separation, perhaps central banks would have less of a job in that regard. But given where we are, it's always good to think about what we can do from different institutions and also in central banks. And today we really covered a broad range of issues. I would like to thank again for all of you, Marcus, Adam, Olivier, and Tharman, for joining today. I tremendously enjoyed our session, and I would like to end this with this note and take care. Bye.
Thank you, Phyllis.
Bye.